Kentucky. Mr. Barr.
Thank you, Mr. Chairman. Chairman Bernanke, thank you for your service and for your testimony here today. I've listened to your testimony, and I have an observation and a couple questions. The observation is this. The Fed has held interest rates near zero for 4 years now. The Fed's balance sheet has more than tripled to $3.5 trillion and continues to grow. Today you have testified that a highly accommodative policy will remain appropriate for the foreseeable future, and yet unemployment remains at 7.6%. 54 consecutive weeks of unemployment higher than 7.5%. Only 58% of the working age population is employed. 5 straight years of declining wages, 3/4 of the American people living paycheck to paycheck, and GDP growth remains well below the long-run average of 3%. All of this has happened coincident to a time when the role of government has grown dramatically as a percentage of our economy. Higher taxes, stimulus spending, government bailouts, Obamacare, Dodd-Frank, skyrocketing compliance costs on financial institutions, and crushing overregulation of the energy sector by the EPA. Given these realities and the Fed's extraordinary expansionary monetary policy, struggling American families are asking the following very important question. What is the cause of weakness and persistent weakness in our labor market? Is it the relative ineffectiveness of the Fed's monetary policy, or is it the fiscal policies like higher taxes, Obamacare, Dodd-Frank, and overregulation by the EPA? My question is related to the exit strategy. During testimony in front of Congress last month, you refused to rule out tapering by the fall time period. The Federal Open Market Committee then released a statement that the Federal Reserve, quote, will continue its purchases of Treasury and mortgage-backed securities and employ its other policy tools as appropriate until the outlook for the labor market has improved substantially in the context of price stability. You reiterated that today. These are hardly definitive statements about reducing the Fed's unprecedented and aggressive bond purchase program. Yet the average 30-year fixed-rate mortgage, as we've discussed earlier today, jumped by 42 basis points. The Dow suffered back-to-back declines of more than 200 points, and billions of dollars were traded out of credit funds after you said last month that the Fed could start winding down bond buying later this year. Given the sharp reaction of the credit markets to even the possibility of tapering, how will you prevent a catastrophic spike in interest rates when you actually do slow bond purchases?
By communicating, by not surprising people, by letting them know what our plan is and how it relates to the economy. You talked about the weakness of the economy. I think that's evidence that we need to provide a continued accommodation, even if we begin to change over time the mix of tools that we use in providing that accommodation. You said a lot of correct things about the weakness of our economy. I agree with a lot of what you said. On the other hand, it's the case that we have made some progress since 2009, and many people think of the United States as one of the bright spots in the world. We're doing better than a lot of other industrial countries. And while we're certainly not where we want to be, at least we're going in the right direction, and we hope to support that.
Well, given the persistent high unemployment, it seems to me that American families who are struggling, many of whom are in my district in eastern Kentucky, who continue to remain unemployed, persistently unemployed, and as you testified, the underemployment problem persists in the country. I think they justifiably have to ask themselves, given the expansionary policy that you have pursued quite aggressively, and to your credit, there's got to be a fiscal policy problem here that has created this uncertainty. Let me conclude with by bringing to your attention a quote that a commentator recently had to say about Fed policy, and I would like your reaction to it. Quote, if the economy begins to improve and the Fed does not withdraw the tremendous reserves it has created from the banking system, rampant inflation will follow. If it does withdraw reserves quickly, interest rates will rise rapidly. This situation makes economic calculations extremely difficult and makes businesses less willing to invest, especially for the long term. If business owners could fully trust the Fed, this would not be an issue, but we have all been burned too many times to trust the Fed. Can you respond to that?
Well, there have been people saying we're going to have hyperinflation any day now for quite a while, and inflation is 1%. We know how to exit. We know how to do it without inflation. Of course, there's always a chance of going too early or too late and, not hitting the sweet spot. That happens all the time whenever monetary policy tightens. But we have all the tools we need to exit without any concern about inflation.
Time of the gentleman has expired.